Hi, I'm Lisa Covey, Senior Accountant at Acuity powered by Soren. Today is going to be the first of two parts on inventory. We're going to talk today about the inventory adjustment and what that means, and then comparing kind of from the accounting perspective what your inventory looks like on your balance sheet and comparing it to real life at what you actually count at your warehouses. There's my dog Jameson. And then part two will be once you have clean books that tie out really well to what's happening in real life with your warehouses, some of the cool things you can do with inventory to help forecast and strategically plan, including adding in landed cost or raw inventory and stuff like that. So again, today will be part one, just the intro, and I will tell you about the inventory adjustment in a moment.
Inventory Part 1, Intro to Inventory. So the typical growth cycle of an e-commerce business is survive by any means possible, become profitable, make sure there's enough inventory to meet demand, and sustain any future growth that you have planned. And then as that kicks off, you start thinking about margins, becoming more efficient, and eventually you're going to realize, you know what, I've been kind of just throwing everything into an Excel file. Maybe I do have a Zero file or a QBO file, but I don't really know what I'm doing. It's time to hire some professionals because I want to see if my revenue is actually what I think my revenue is, if my expenses are in line with what I think. I know my bank account is going up each month, but I want to verify, am I actually making money and how much money am I really making? So I can start thinking about some strategic planning for the long term. So you, like, all right, we're hiring accountants, and they're going to come in, and it might be humbling depending on how well your books have been kept. But as Snoop Dogg said, sometimes a loss is the best thing that can happen. It teaches you what you should have done next time. So it doesn't matter how messy your books are. You're moving forward. You've hired professionals to take care of it and clean it up. And now you've got an accurate picture. You're feeling good about your revenue expenses. One thing you probably haven't thought of before that your accountants are going to point out, they're also going to clean up your balance sheet. On the balance sheet, there's going to be an account called inventory, and it's going to have a month-end balance, and they're going to compare that to what your reports are from your warehouses, whether Amazon, 3PLs, a physical warehouse you have on site, but what your month-end inventory account you're reporting is. And there's probably going to be a big difference. Here at Acuity, we create another balance sheet account called the inventory adjustment, which basically is we use to tie out the difference between your inventory in books and your inventory in real life at month end. And ideally, a perfect world, this inventory adjustment would be zero. It's just not there. It's so small to be non existent. Typically, we like to have it less than 10% of inventory. Um, and in a perfect world, it would be less than 5% would be fantastic for an inventory adjustment, maybe oscillating positive and negative each month, just with timing difference and stuff. But again, the smaller the better. I bet when your books get cleaned up for the first time and you look at that inventory, there's going to be a big difference. And there could be a lot of reasons why. It could be inputs on the book side of things, it could be the inputs on your warehouse side of things. Could definitely be both. But your accountant's going to help you kind of troubleshoot like where the issues are coming from and try and get that inventory balance to match up closer to real life. Some of the things you could be finding that are incorrect on the book side of things. Invoices could be coded correctly. Maybe you're coding things and expensing them onto the income statement instead of putting them in inventory on the balance sheet, even though you're pulling it in as inventory in your warehouse. Could be vendor deposits. If you buy something that isn't going to ship for 6 months and you've got to pay 50% down to get them to start manufacturing the order. So say it's a big order, $100,000, you have to pay $50,000 this month, but it's not going to ship for 6 months. You take that $50,000 invoice and you put it in your system into inventory. It's sitting on your books creating a discrepancy, even though you haven't received it into any of your inventory systems until it ships. So that's a $50,000 difference right there. It should be coded to a vendor deposit that you track separately on your balance sheet. And then maybe you're trying to use landed costs, but without clean books or a clean process for recording landed costs, that's creating some big discrepancies. Say you're recording packaging cost as landed cost and you're putting it into inventory on your balance sheet, but you're not actually adding it as inventory when it comes in any of your warehouses, then that's going to create a discrepancy as well. So those are some of the issues that can come from the book side. The warehouse side of things could be maybe you're just not receiving inventory in a timely manner. Maybe it takes you a month or two to get it into your warehouse, like received into the software there, which would create a discrepancy if the bill is in your accounting software that month. Could be you're not updating your COGS timely if you have a SKU that maybe the cost has gone way up or way down and changed significantly month to month. and you're not updating that, it's going to throw off your inventory valuation and also the hogs you're expensing or that are coming out of your inventory amount in your cloud inventory software. And it could be just items that are being received as inventory in your warehouse that actually aren't inventory. A common one we find is equipment on your books. It's going to go in as a fixed asset and get depreciated. But a lot of times we found clients will pull fixed assets into their cloud inventory system. You can do that to show you've received it. You do want to mark it as a non-inventory item though, which many just don't know or aren't aware of. Otherwise, that's going to throw off your inventory balance as well. So that is inventory 101. What I went over today is what accountants call buy cost. When you're just adding your inventory into the balance sheet on your accounting software and it's tying out to what you have on your warehouses in real life. Once that's nice and tightened out and accurate each month, then you can start looking at some more advanced inventory things, like including landed cost or adding raw inventory in there. And next, that'll be for part two. I will go over uh, kind of why you would want to use something more complicated anyway, like a landed cost and raw inventory, and then some pitfalls you need to keep in mind as you're setting that up, or if you're already using it, just to make sure it's as accurate as possible. So until then, I'll see you out there.